Very good evening to all the participants. It's my pleasure to connect with you once again over this virtual platform. And in this series of Back to Basics, we have been doing sessions every Tuesday over the last couple of months. And we are really encouraged with the feedback which we have got till now. And would request you to share further feedback and also suggestions of further topics or initiatives which could be taken by us in rendering the services to you. The topic today, friends, is relating to exemptions. And this topic has connections with multiple facets which we have talked about in the past. So in a couple of slides, we will quickly go through some of the principles which have been discussed in the earlier sessions of Back to Basics. And thereafter, we'll go to the specifics of the topic relating to the exemptions itself. As we are aware, friends, the levy provisions come from Section 9 of the GST law, which is a very comprehensive provision, which says that there will be a levy of GST on all intrastate supplies of goods or services or both. Of course, we are aware that liquor and petroleum today are outside the purview of GST, and therefore those two products, supplies of those two products is not into GST. But subject to those two products, if we refer the provisions of the law, the law is universally applicable to all the supplies of goods or services. Thereafter, we have Schedule 2 and Section 8, which deal with principles of classification, and they try to classify transactions into supplies of goods or services. And having said that, thereafter, the rate for those taxes come through executive action by way of notifications. We are aware there are two notifications, one dealing with the rate of tax on goods, another dealing with the rate of tax on services. And as we move forward, we will also understand that as far as the exemptions are concerned, that is also through a separate series of notifications dealing with goods and separate series of notification dealing with services. And friends, therefore, the principles of classification, the dominant intention, whether you will classify something as goods or something as services, becomes very important, because the rate of tax as well as the eligibility for exemption would both be decided based on whether something is constituting a supply of goods or a supply of services. Let me take a very simple example. We are told healthcare services are exempted. Now, naturally, these healthcare services are provided by doctors, and as a priority, we do not want to tax those services. So there is an exemption for that. But that exemption is available under the service notification. Therefore, if a doctor is supplying some goods, let's take an example. He has some old furniture in his nursing home and he sells those old furniture. That sale of furniture, the principles of classification will suggest that this furniture is goods. All of us are aware of this, and this has been discussed in the earlier sessions. And therefore, for the supply of furniture, there would be a tax implication. Just because it is sold by a nursing home or by a doctor will not give them an exemption in that manner. And therefore, this classification of goods and services, though we say GST is a common law for the purposes of tax rates as well as exemption, this classification becomes very important, and we need to bear this in mind as a starting point. What are you doing? Are you providing goods as a sale, or are you providing services? Of course, we are also aware of the matrix wherein we are told that when you are looking at a works contract, those works contracts will always be deemed to be services. That comes under Schedule 2. A specific provision has been laid down to that effect, that composite works contracts will always be considered as rendering of services only. So, with that little bit of a background of what we have discussed in the earlier sessions, I would now take you through the topic for today, which is relating to the exemptions. And as we go into those exemptions, before I really take you through that, let me just request all the participants to keep their Zoom account on so that to avoid the disturbance. May I request everyone to keep themselves muted? Of course, if there are doubts, we will take them up towards the end of the session, and at that time we can unmute yourself and ask those doubts. But subject to that, please keep yourself muted so as to have a disturbance-free approach towards the entire session. Coming to the exemptions, there is a provision under Section 11. Section 9 basically says everything in the world will be taxed in terms of supply of goods or supply of services. And thereafter, Section 11 then allows the government to, through a notification, provide for some exemptions. Now, what does it talk about? It talks about different types of exemptions. The exemptions can be general exemptions. General exemptions are exemptions which apply to everybody in general. A very simplistic example again would be, let's say, a services in the nature of healthcare services, or some services which are renting of residential accommodation. Now, these are general exemptions available to everyone. They can be either absolute or conditional. So when you look at healthcare services, they are general exemptions. But when you look at renting of residential property, we are told it should be used for residence. So there is a condition which is given to it. So it could be absolute, it could be conditional. Again, the exemption could be from the whole of tax or part of the tax. So sometimes they might say the general tax rate is 18%, but I want to give you an exemption. I want to reduce that tax rate to 5%. So there's an exemption which is given to the extent of 13%. And that is a partial exemption. In other cases, there can be a full exemption from a tax. Only important aspect which we need to bear in mind is, of course, we'll go into the definitions a bit later. But if there is a whole exemption, then the transaction is treated as an exempted service. If it is a partial exemption, if at all there is some tax to be paid, then it is not to be defined as an exempt service. So that when we go to the next slide, we'll be talking about the definition of exempt service as well. And there we will understand this thing in a little bit more detail. There could be some exceptional cases where the government might provide for an special exemption to a particular class of people. Maybe those special exemptions can be also provided in a retrospective manner, assuming that certain people did not collect the tax at all, and therefore a retrospective exemption can also be provided through such special exemptions in exceptional cases. If there is some doubt on the exemption, they can issue a clarification to by way of an explanation, and that clarification will again date back to a prior period. An important aspect to bear in mind is, if there is an absolute exemption, in that case, you are not permitted to collect the tax. And that is going to be very, very important because in many cases, as a conservative approach, many organizations choose to pay the tax even though there might be a very clear exemption available. Now, this provision clearly says that if there is an absolute exemption, just to maintain the input credit chain, you cannot collect excess tax. Yes, if you have collected those excess tax, they will forfeit that excess tax. But if there's an absolute exemption, there will be a denial of input tax credit also. And therefore, if you are in an exempted zone, then just by as a conservative manner or to maintain an input tax credit chain, you cannot forego the exemption and pay the taxes on those transactions. So this is what section 11 broadly talks about. And to implement the specifics of these items, we have two notifications. Notification number 2, which deals with exempted goods, and notification number 12, which deals with exempted services. So both those notifications are separate, as we discussed in the earlier slide. We need to bear in mind that services are given a separate exemption notification, whereas goods are given a separate exemption notification, and therefore principles of classification will become very important when we are interpreting any exemption notification or looking at any tax concession on account of an exemption. Now, what is meant by exempt supply? We have our definition of an exempt supply, which says it means supply of any goods or services or both, which attracts a nil rate of tax under the statute itself, or which may be wholly exempted from tax under section 11, the provisions which we just discussed, and includes a non-taxable supply. Now, therefore, through a circular mechanism, we now go into what is meant by a non-taxable supply. We are told non-taxable supply means a supply of goods or services or both, which is not leviable to tax under this act or under the IGST Act. So typically, when you look at petrol and alcohol, these are products which are not leviable to tax under the act. Though there is a supply, and that supplies of goods or services, it is still not leviable to tax, and therefore it will be defined as a non-taxable supply. As compared to that, exempt supply is wider. It will include goods or services which are under the GST law, but are given a nil rate of tax or an exemption, wholly exempted, as we said, for the services. Now, when we are looking at exempt supply and non-taxable supply as definitions, we may also need to bear in mind that there will be receipts which may not fit within any of these baskets, and you may not end up paying a tax. A very common example would be something like a sale of securities. Now, as you know, securities are defined neither as goods nor as services. It is outside the definition of goods, it is outside the definition of service. And therefore, when you sell securities, you don't end up paying a tax. But that does not mean it is an exempt supply or a non-taxable supply. And all of this will have implications when we are filing your GSTR 1 and 3B, where there are specific rows to declare the value of exempted supplies and declare the value of non-taxable supplies. While you will declare those values in case of securities, because it is neither a part of exempt supply nor a part of non-taxable supply, there will not be any requirement of disclosure in the GSTR 3B or in GSTR 9. Same thing applies to dividend income or many other types of revenues, which you might have an income, but that income may not be a consideration for supply of goods or services or both. So this is what we need to keep in mind when we are looking at the definition of exempt supply versus non-taxable supply. Also, friends, make a note that the term exempt supply includes nil rate of tax, but under the GST law, there is a difference between a nil rate of tax and a zero rating of tax. Zero rating, as we all know, is when you supply goods to an SEZ unit or you export goods or services. In those situations, you are given a zero rating benefit under Section 16 of the IGST Act. You can export or supply against an LUT, letter of undertaking, and you don't charge any tax. Now, that zero rating is not treated as an exempted supply. It is treated as a normal taxable supply. And of course, there is no ramification of input credit reversal. So that is one more aspect or a basket which we need to bear in mind. So effectively, when you look at the entire structure, you might have something known as a taxable supply where you end up paying a tax. There will be a zero rated supply where you will not pay a tax but not treat it as exempted. You will then have an exempted supply, which is basically through some notification or a schedule, there is a nil rate of tax. And thereafter, you will have a non-taxable supply, which will be basically your petrol and alcohol. Over and above this, there might be receipts which don't fit in any of these four baskets. And if they don't fit in any of these four baskets, in that case, there is no requirement of any specific type of a disclosure in that regard. And this is what we try to summarize here, that supplies can be of goods or services or both. And they get classified, as I was highlighting, into taxable supplies being normal rated supplies or exempted supplies, or it could be non-taxable supplies in the nature of alcohol or petroleum, or it could be neither a supply of goods nor supply of services. An example which I gave you was a transaction in security. Similarly, transactions in monies are also neither supplies of goods nor supplies of services. Also, there is Schedule 3, which deals with 8 to 10 items like sale of land, employment contracts, and those items which are a part of Schedule 3. You have high seas sale, which is also specifically listed in Schedule 3. Now, these items are neither supply of goods nor supply of services. If they are neither supply of goods nor supply of services, there is no requirement of any ITC reversal. There's a specific provision which talks about it. At the same time, there is no requirement of disclosure in your GSTR 3B or in your GSTR 9. So that is how we will have to look at the overall context within which we have to define what is meant by an exemption. Having understood the specifics of the context of the exemption entries, we now go to understand some general principles, because exemption is a topic which has been there ever since the indirect tax law has been there. We have had exemptions in the VAT regime, in the excise regime, in the service tax regime, and even direct tax, income tax, there are so many exemptions. So whenever there are exemptions, there's always going to be an interpretation or a debate, because when you look at the classic tug of war, you always find that an exemption means you don't end up paying a tax. And therefore, the government officer will always feel that you are evading or saving some tax. And therefore, there's always a risk of the officer asking you questions of demonstrating whether your exemption is correct or not. And many a times it results in litigation. Many of these types of litigations in the past have reached the courts. And we find that the courts have settled down certain principles of how a particular exemption entry should be interpreted. So in the next couple of slides, we will spend around 5-10 minutes understanding how an exemption entry should be interpreted. And thereafter, we'll deep dive into some of the specific exemption entries. And when we look at some of the decisions, we have a very interesting scenario in the first case. And this situation was a case where there was an entity which was doing some live entertainment in the state of Gujarat. And at that point of time, there was an entertainment duty applicable on recorded events. And the Entertainment Tax Act had an exemption entry which gave a conditional exemption to live events. Now, this Gypsy Pegasus was doing some live events, but it was not satisfying one of the conditions which were mentioned in that exemption notification. And therefore, the Gujarat authorities said that you please pay me an entertainment duty. Gypsy said that, look, I am doing a live event. The Entertainment Tax Act itself applies only to recorded events. And if that be the case, why should I even go into the exemption notification or the exemption entry? Matters went to the courts, and the Supreme Court nicely analyzes this, and it says that you cannot use an exemption entry to indirectly demand a tax. Whether when the government wants to demand a tax, they have to go through first the basic taxability provisions. So, for example, when we look at GST, the basic taxability provisions comes under section 9. The levy comes under section 9, which is a GST is applicable on all supply of goods or services or both. So before one really goes into an exemption entry, one will need to identify whether there was a taxability. Now, let me give you a couple of examples to drive home this point from a GST perspective. We have an exemption entry which says that supply of services by way of a sale of a going concern, sale of an undertaking as a going concern, will not be liable for GST. So there's an exemption entry to this effect. Now, therefore, many a times there are doubts raised at a ground level. Two types of situations or challenges which are raised by the department at a ground level. When an organization hives off a business either by way of a demerger or by way of a slump sale, the department raises two objections. Firstly, they try to say that that you are not sold the business, maybe because you sold only a part of it or something like that. And therefore, they might say that this exemption entry is not applicable to you. And in some cases, what they do is they say that, okay, I agree with the exemption, but please reverse the corresponding input tax credit under Rule 42. In the next few slides, we'll also talk about Rule 42, 43. And that is where this defense comes into place. What we need to highlight here is that when there is a slump sale, whether that slump sale, business sold as a slump sale, whether that is a supply of goods or services or both in the course or furtherance of business. Because as we know, Section 7 defines supply to be a supply only if it is in the course or furtherance of business. Can one say that a business is into the business of selling businesses? And the answer is clearly in the negative. In the VAT regime, we have a few decisions to this effect. And therefore, one would believe that these are examples where there was no taxability at all. And one can quote this Supreme Court decision to say that just because there is an exemption entry given in the notification, that does not presume taxability. At the outset, if there was no taxability, then you cannot treat this as an exempted supply at all. So this is one interesting decision which one will have to bear in mind. The second one is a decision which most of the times the department will quote whenever they want to deny you the benefit of an exemption entry. Dilip Kumar and company recently again revalidated in Hajj committee's case. And all these decisions basically try to bring about that if there is an exemption has to be strictly interpreted. And if there are conditions mentioned in the exemption notification, all of those conditions need to be satisfied and complied with. There is no procedural or intentional interpretation of an exemption entry. And therefore, this does result in sometimes a lot of difficulty which comes out, especially when there's an end-use based exemption. Again, let's take an example wherein we are told that renting of a residential dwelling for residential purposes is exempted. Now, this is an end-use based exemption. Now, in these types of end-use based exemption, how do you interpret whether the property which has been rented is ultimately used for residential purposes or not? Yes, the person is staying there. But in today's atmosphere, there is a lot of concept of work from home. And in the recent times when the reverse charge entry was being introduced, there was a lot of debate on this aspect. That if a person is generally residing in a house, let's say a tenant residing in a house, for 1 hour or 2 hours, he might be working from home or sometimes even for the full day, he might work from home, from his bedroom or in one of the halls. Now, if that be the case, can the end use based exemption be denied because the property is not ultimately used for residential purposes? Now, in that context, the Supreme Court decision of Mother Superior Adoration Convent is very important. While an exemption entry has to be strictly satisfied or followed, in case of an end use based exemption, the exemption has to be examined from the principal end use and not exclusive end use, which means that if principally the property was rented for the purposes of residence and is primarily used for residential purposes, just an incidental use of the property as a work from home concept, wherein there might be some calls attended from the home or meetings attended from home, would not convert the property to be that of a non-residential usage. So I think that way, this decision can be a very interesting decision which one can keep in mind. Another is a decision of Mahindra and Mahindra. Again, this is a decision of interpreting how the difference between an absolute versus a conditional exemption. And as we all know, absolute exemption is thrust upon the taxpayer, whereas a conditional exemption is optional, in the sense that you might say that I don't want to satisfy these conditions. I want to pay the tax and maintain the input credit chain. So in that context, I think this decision again becomes very important. A couple of decisions on the applicability of an exemption entry. We are told that an exemption entry will be applicable prospectively. So if an entry is introduced giving an exemption, from that exemption will be effective from the date when it is notified, unless specifically mentioned. If the government wants to give a retrospective exemption, they will clearly mention that it is a retrospective effect. Otherwise, it will have to be interpreted only prospectively. While the government can give a retrospective exemption, the question which came up in one interesting case before the Supreme Court was, if initially an exemption is given, and after a couple of years, the government finds that people are misusing the exemption, whether the government can withdraw the exemption from a retrospective date. And when this happened in one of the situations relating to excise incentives, the taxpayer said that, look, you had promised me an exemption, and based on that exemption, I set up a unit in a backward area or something like that. And now you are retrospectively withdrawing that exemption. It means you are, as a government, you are going back on your promise. There is the principle of promissory estoppel. And therefore, the taxpayer said that you cannot retrospectively withdraw an exemption. Supreme Court painfully came to a conclusion that in this case, there has been a rampant misuse of an exemption entry which was given. And in case of such rampant misuse, the government can withdraw the exemption through a retrospective amendment. And there is no promissory estoppel whenever an exemption is given. And therefore, one has to be very careful that whenever there is an exemption given by the government, that exemption is given with some intention, background, thought process in mind. And when we read the speeches of the finance ministers, or we read the circulars or the clarifications issued at that point of time, and also look at the context in which that exemption has been given, we may be able to interpret the eligibility of an exemption entry. Any interpretation which does not align with this type of a concept may result in a difficulty. And many of you might be aware, and this has made news in the newspapers recently, that there was an exemption for various types of food grains and daily food necessities. And in this GST Council meeting, in the last GST Council meeting, the exemption has been restricted to only cases which are not governed by the Legal Metrology Act. Now, this Legal Metrology Act has a provision that it applies only to packages up to 25 kgs of weight. And therefore, especially, things like rice and tur dal, etc., many people have aligned themselves and tried to change that 25 kgs to 26 kgs. Now, while someone might do that, please note that this is not something which is the intention of the government. The intention of the government is branded products, when they are put up for retail sale in a packaged mode, it should be liable for GST. And therefore, while as of today, it might appear perfectly okay to claim the exemption because you have started selling 26 kgs of rice instead of 25 kgs. Tomorrow, if the government brings a retrospective, Hello.
Yeah.
Can we please keep ourselves on mute for a few minutes? Yeah. So if the government brings in at a later point of time a retrospective amendment, considering the theme of affairs as quoted by VVF case in Supreme Court, we might have a risk that all these cases there can be a withdrawal of an exemption from a retrospective date, and that again can be, of course there will be a lot of litigation and furor around that, but that's a possibility which one needs to bear in mind when one plans affairs in this manner. There's this Gujarat Ambuja decision which says that an HSN explanatory notes will not be useful for interpretation of exemption notification. Now, this again is an important aspect. When we go to the exemption entries, we will see that those exemption entries are typically based on HSN classification, but the description mentioned in the exemption entry may be very different from the description mentioned in the HSN classification. And in that type of a situation, what is mentioned in the exemption entry will prevail, and one cannot use the guidance of HSN for the purposes of interpretation of the exemption notification. Finally, one relief type of a judgment in Sonelec Paints case and many other situations have been laid down, wherein in some exemption entries there's a condition that you can claim the exemption if you are not claiming input credit. Now, in this case, there was a situation where by error the entity claimed input credit and also claimed the exemption, and later on when they realized this issue, they reversed the input tax credit. In this case, the Supreme Court said that the delay in reversal of input credit is a condonable procedural lapse, and therefore it should be allowed, and the exemption should not be withdrawn merely because there was a delay in the reversal of input credit. Now, with that limited interpretation of the principles of exemption entries, we now go into looking at some of the provisions under the GST law. A common question which comes up is, I am an exempted supplier. If I am an exempted supplier, do I need to obtain a registration? I am a doctor. My turnover is about 20 lakhs because, as we know, the threshold is 20 lakhs. So if I am a doctor providing healthcare services and my turnover is about 20 lakhs, do I need a registration? The answer to that lies in the definition of aggregate turnover. And as we know, the term aggregate turnover includes value of exempted supply. Now, Section 22 by itself says that every person whose aggregate turnover exceeds the 20 lakhs limit is required to take a registration. The saving grace comes in Section 23, which says that if you are a person who is exclusively engaged in exempted supplies, there is a concession and you shall not be liable for registration. So far so good. The doctor, he has a turnover about 20 lakhs, and because of 23 section, he will be not liable to obtain registration, and so far so good, and that's the intention. Now we bring in one more provision, which is Section 24, which says that in certain cases, compulsory registration will be obtained irrespective of the threshold. And one of the situations there is a situation of reverse charge mechanism. Now complicate things a bit. We have a scenario where we are told a doctor providing healthcare services is not required to obtain registration because of Section 23. Now that doctor, there's a case filed by a patient, and therefore he appoints a lawyer to defend his case under the Consumer Protection Act, and he pays a fees to the lawyer. As we are aware, legal services are under reverse charge. Now, in these types of situations, Section 24 says you have to compulsorily obtain a registration. So the question which comes is whether Section 23 will prevail or Section 24 will prevail. And there have been conflicting decisions on this front. A better sense would be to say that Section 24 overrides Section 23, and therefore, in these cases, at least to discharge the reverse charge mechanism, a registration would be required. The second aspect of exemption comes in Section 17, wherein we are told that if you are claiming input tax credit, the whole objective of giving input tax credit is to remove the cascading effect of taxation. And therefore, if you are not paying tax on your output side because they are exempted because of a policy decision, then you should not be eligible to claim the input tax credit. To bring that principle into light, we have Section 17(2), which says that a registered person is required to reverse the input tax credit to the extent of the value of exempted supplies. Then we have rule 42 and 43, which deal with how to identify the value of the proportionate reversal of input tax credit in case of exempted supply. And there's a very detailed code in that. I am sure one of the sessions we have dealt with this in detail. And of course, it's always a complex exercise to undertake that entire exercise to reverse provisionally, and then finally the input tax credit attributable to exempted supplies. Having said that, please note that input tax credit and also a refund is available for exempted supplies which are zero rated. For example, if there is a case that somebody is providing an exempted goods, but he is exporting those exempted goods, then the corresponding inputs are still eligible for input tax credit. In fact, that's a major concession which has been given in case of exporters and SEZ suppliers. So this table summarizes various situations and its disclosure in 3B and also its impact on ITC reversal. Now, please note there is a difference between both of them, because when you go to Rule 42, there are certain items which may be traditionally exempted but not treated as exempted for ITC reversal. And there are other areas also where something may be traditionally not an exempted supply, but for the purposes of ITC reversal, it might be treated as an exempted activity. So therefore, both of these are slightly independent of each other, and one will have to deal with them separately. And each of them we will now spend a few minutes understanding the disclosure requirement as well as the ITC reversal requirement. So the first aspect is zero rated supplies of exempted goods or services, which basically means exports or SEZ supplies on payment or without payment of tax. Of course, because it's exempted, most of those examples would be on without payment of tax. Conceptually, these are exempted supplies, and therefore you will report it as exempted supplies in 3B, but you will not reverse ITC, because section 16.2 itself very clearly says that as far as exempted goods or services are concerned, if they are zero rated, they will not be treated as an exempted supply and no reversal is required. Domestic supply of exempted goods or services, yes, for both, it will be disclosed as an exempted supply in 3B, as well as an ITC reversal will be required under Rule 42 also. And whenever we are talking about Rule 42, similar principles will apply to Rule 43, dealing with capital goods reversal also. As far as sale of land and building is concerned, no, it's neither as goods nor services, and therefore there is no requirement to disclose it under GST or 3B. But when it comes to reversal, yes, there is a requirement of reversal. There is a explanation to Rule 45, which defines the value offered for stamp duty purposes as the value on the basis of which the reversal will be undertaken. Sale of securities, again, is neither a supply of goods nor supply of services. Therefore, no reporting required in GST or 3B. But again, explanation to Rule 45 defines the value as 1% of the sale value, and that will be a subject matter of the reversal which you need to do for the purposes of Rule 42. Supplies covered under reverse charge, they are not exempted supplies at all, but for the purposes of ITC reversal, section 17.3 specifically treats it as an exempted supply, and therefore you will have to reverse if you are providing output services which are subject to reverse charge. Now, this typically will impact logistics providers who might be providing other services, let's say storage services which are under forward charge, and GTS services which are under reverse charge. Now, in case of common credits, there will be a reversal required. Even GTA is not exempted activity. The recipient is going to pay the GST on reverse charge mechanism. But as a logistics service provider, there will still be a requirement of reversal on this front. We are also facing situations in event companies where they receive normal event fees and also receive sponsorship revenue. Sponsorship revenue, as we know, is under reverse charge mechanism, and therefore the recipient will be paying the GST on it. Therefore, there will be a requirement of a reverse charge on that front as well. That takes us to interest, and interest, we have had an interesting debate in the initial period. Thereafter, things have settled down because of amendments in the law. Effectively, we are saying interest for loans advanced is not liable for GST because of a specific exemption entry, and therefore it is to be reported as an exempted supply. So yes, it is an exempted supply, but because of an explanation 1 to Rule 43, it is not to be treated as the value of exempted supplies for the purposes of ITC, and so you will not disclose it for Rule 42 for the purposes of reversal. Similar treatment for ocean freight, which, as we know, export ocean freight is exempted from payment of GST, So yes, it will be reported in 3B accordingly, but no ITC reversal is required. Same way, except land and building, Schedule 3 transactions are outside the taxable territory like high seas or sale from bonded warehouses and or transshipped cargo. And in these types of situations, no reporting required in 3B, no reversal required in Rule 42. So this is a snapshot of how the exemption will interplay with your disclosure requirements as well as your ITC reversal requirement. Now, with that, we go into the understanding of the exemption entries, and there have been quite a few exemption entries. Quite a few of them have been realigned in the recent GST Council meeting, and they have deleted so many of those exemption entries. I think the thought process is very clear to keep as minimal list of exemptions as possible. But despite that, there are quite a few of them, and it may not be possible to take all the entries, and it may become as fairly tiresome to go through entries which are very, very specific to specific types of taxpayers. So what again we'll do is we'll try to understand the structure of those exemption entries. And if we have to look at the structure, I think the exemption entries can be divided into various types of exemptions. First is an exemption which is based on the nature of the service. And an example which we can give is loading, unloading, packing, storage, or warehousing of rice. So now when we look at this type of an entry, please note that whenever you want to claim the exemption, you have to satisfy one of the first 5 activities which have been mentioned. Here, there is an exemption for 5 activities, which is loading, unloading, packing, storage, or warehousing. Now, if you are doing something which is different from these 5 activities, let us say you are doing some job work relating to it. Let us say you are converting that rice into a flour. Now, that type of a job work is not a part of the 5 entries mentioned here, and therefore it will not be eligible for the exemption under this entry. That also takes me to the aspect of the next part of this entry itself, which is that it applies to rice. So after the rice has been converted into a flour, if there is loading, unloading of that flour, then this entry will not help you. If at all there is another entry, you will have to look at that. But this entry, you will look at from the perspective of rice only. Go back to the Dilip Kumar's case, and the Dilip Kumar's case clearly says that each exemption entry has to be strictly interpreted. And therefore, one will have to read this entry in the basis of the nature of the service which has been rendered. There are exemption entries, and we touched upon this, which are based on the end use of the service. And we have entry 12, which is renting of residential dwelling for use as residence. Now, as we are aware, the recent GST Council meeting has made 2 changes here. And that's the reason why we thought we'll touch upon this entry at this juncture. This entry is now subject to one important caveat, which says that renting of residential dwelling for use as residence other than by a registered person. And therefore, if the renting is to a registered person, and we have examples where companies obtain properties, residential properties on rent for their directors to stay, and they offer it as a part of the perquisites. Now, in these types of situations, we are told that the exemption is no longer applicable. And another RCM entry imposes reverse charge in these cases on the registered person. So if companies have obtained, companies or even any registered person for that matter, has obtained a residential property for using it as a residence, it would be under the RCM and the exemption entry will not apply. There's also a debate of whether input tax credit is available. The answer to that would depend on the end use. If ultimately the property is being used for the purposes of businesses, then the credit will be available. But if it is a part of a perquisites given for an exclusive use by a director, then the input tax credit, there is an exclusion which says that services for personal consumption are not eligible for credit. And therefore, there will be a denial of input tax credit on that front. So there is a second type of an exemption entry, which is based on the end use. As we said, end use, you have to look at the principal end use and not the incidental end use. And of course, there might be a need to obtain a certificate from the end user to demonstrate at some point of time that the property or that particular end use is being satisfied. Some entries give exemption based on the nature of the supplier. And this is an entry which says that if there is a service relating to transmission and distribution of electricity, by a transmission and distribution utility, then it will be exempted. And this is where we have lots of situations where there has been a debate. Let us say there is a landlord who is giving his property on rent, and he sets up a DG set to provide a common electricity or a standby electricity to all the tenants therein, and he recovers the electricity charges as a part of the common maintenance charge, or maybe as a separate specific charge as an electricity consumption. Sometimes he might procure electricity and redistribute it to the tenants. And then the question is whether that will be exempted from payment of GST. If you read this entry, this entry gives an exemption based on the nature of the supplier. The landlord would not typically have a license from the under the Electricity Act to act as an electricity T&D utility, and therefore this exemption entry may not apply to that landlord, and he would be required to collect GST even on the electricity reimbursements. That is where the exemption entry, which is based on the nature of the supplier and the strict interpretation of that entry, will result in some difficulties on this front. The next type of an exemption entry would be an exemption which is granted based on the nature of the recipient. And a very classic example which one can give is services provided to government in relation to a municipal function. So here it's actually a combination. It's both a recipient driven entry as well as an end purpose driven entry. Now, and here also we had a lot of challenge in the earlier part that how do you go and define a government? So in engineering services which are provided to a government in relation to a municipal function would be exempted under this entry. But then how are you going to satisfy whether it's a government or central government, state government, or a local authority? Of course, one will have to go into the constitution of that body and accordingly take a call of whether that entity is a government or not. And that's where some element of risk would come in. Next exemption entry is based on the nature of the consideration. And here we have an entry which says services by way of extending deposits, loans, and advances against interest. So if a bank gives a loan, it will charge an interest and it will also charge some processing fees. We are told that the processing fees are not exempted. It's only the periodic interest which is given an exemption by entry 27A. Now, interestingly, we have this time a scenario where a taxability is decided based on the nature of the consideration. In the healthcare service, there is now a carve out, and we are told that while generally we want to give an exemption for healthcare services, in case the room charges are above 5,000 per night, only to the extent of room charges we want a tax on that. And that has been provided in the effective from 18 July. We are all aware of the provisions in this regard. Of course, there's a big debate on whether there could be an entry in that nature wherein a taxability can be based on the nature of consideration. The theory of composite supply again can be brought into the forefront. But I would believe being an indirect tax, people would not want to litigate unnecessarily on this matter. And therefore, they would carve out the healthcare services into two baskets, other services and the room related services. And the room related service, again, they would like to check whether it is less than 5,000 or more than 5,000. If it is more than 5,000, they would want to forego the exemption, pay the taxes. And in other cases, they would want to claim the exemptions. In certain cases, again, the exemption is based on monetary limits. For example, maintenance collected by Resident Welfare Association or a cooperative society up to 7,500 per member per month is exempted. Entry 77C is very clear on this front. Earlier, we had many more monetary limit based exemptions, but this budget to this GST Council meeting, two important monetary based exemption limit have been removed, and they are very important for all of us to bear in mind. You are aware that for the transporters, there was a GTA exemption entry which said that if you are having less than 1,500 per trip or 750 for parcel load, then it was exempted. Now that exemption entry has been deleted. So even if you are paying 400 rupees for a transport which has to happen maybe 2 or 3 buildings away, even that would be a subject matter of GST. And as you are aware, GTA is under reverse charge mechanism. So you will end up paying taxes under reverse charge. For the hospitality clients, there has been a removal of the exemption entry for hotel accommodation below 1,000 rupees per room night. And so there will be now a tax of 12% because as you are aware, less than 7,500 per room night is 12%, about 7,500 is 18%. Now this entry will have also an impact on many dharamshalas or small associations which charge a nominal rental for a stay or maybe even a hostel to that extent. Of course, if hostels are run by a school or by an educational institution, they would be exempted under some another entry. But otherwise, even hostel accommodation could create a difficulty in terms of the removal of the exemption entry. So those two things we need to bear in mind. Now, with that structure of exemption entries, I don't think I'll take you through every exemption entry, but in 2 or 3 slides, we've tried to just cover a few selective exemption entries and we'll touch upon that. And maybe then, time permitting, we'll take up a couple of questions on specific exemption entries if people might have. Now, the first sector, which is always a priority of the government, is education, training and education. And therefore, there are a series of exemption entries dealing with some specific activities done by the training and educational service providers. Now, please understand, it's not a blanket exemption. There are specific entries, and 2 specific entries are of relevance, which we will discuss for the next few minutes. The first one is a service provided by an educational institution to students, faculty, and staff. Now, please note, this word educational institution itself is defined, and it's defined in a manner, in a very circumvent manner, to mean an institution which provides recognized education. So it could be a school education, or higher education, higher school education, or any education resulting in a degree recognized by a law for the time being in force. It also includes certain vocational training courses which have been approved by the government. So first thing which one needs to check is whether the institution is providing recognized education in the manner which has been listed in this notification. If you are providing that educational institution, if you are providing that type of an education, in that case, for those courses, you will be exempted because services provided by you to the students, faculty, and staff will be outside the purview of GST. Now, as far as the services to students is concerned, they are talking about the entire life cycle, including the initial activity of enabling a person becoming a student. So all your admissions or the expense or revenues concerned with the admissions of the student and the conduct of entrance test. Also, after his exit, if you are giving him some transcript fee, transcript services and charging a transcript fee or a migration certificate, all those types of services are also exempted under this entry. So in that sense, a fairly wide entry will cover a lot of things when the services are provided by a educational institution. Now, in a way, this is the catch-22 situation, because while the educational institution will not collect taxes from the students, when it procures various goods or services from third parties, those third parties are not given any specific type of an exemption. A very classic example is renting by a third party to an educational institution. There is no exemption for that, and the third party landlord is going to charge a GST to the educational institution, which, as we saw earlier, will not be eligible as input credit to the educational institution, resulting in a cost. Similarly, this educational institution might import various services on which there will be an RCM, and that RCM also will not be eligible for input tax credit. Yes, there is an entry which talks about select services provided by third parties which will be exempted. For example, we are told that transportation services up to a particular level of education is exempted. So one will have to be very careful of the inputs where only selective types of inputs are eligible for the exemption. So that is as far as training and education is concerned. Now, with that principle in mind, we also go to services provided by the government. Now, as a principle, we are all aware that government, while in many cases would be undertaking a statutory function, the law itself provides government as a taxpayer, and it also says that any activity done by a government will be treated as a service unless specifically taken out from the purview of taxation. Now, with that background, we also need to bear in mind that in general, there are only a few items where the government pays tax on the forward charge. Otherwise, it's the recipient who is required to pay tax under reverse charge mechanism. And therefore, we have a few exemption entries which are relevant from you as a recipient. If you are making payments to government and you are paying RCM, you have to check whether those payments are relating to any of these activities. In that case, RCM does not apply. Otherwise, you have to pay tax on government payments under RCM. So what are those exemptions? The first exemption is that if the government provides services to other than business entities, or if the business entity has less than 20 lakhs of aggregate turnover, then the RCM will not trigger. Naturally, they want to safeguard small taxpayers from the purposes from the purview of RCM obligations in these types of situations. Cases where the government is acting as a municipal function, in that as a sovereign function, in that case, there is no applicability of GST because of this exemption entry. So it has to be governed by Article 243W of the Constitution. So when a municipal corporation collects various types of charges in continuation of its function delegated under Article 243W, then there is an exemption entry available. Then we are told that if there is a small value, and a transaction value for the transaction is less than 5,000 rupees, then it is exempted under one more exemption entry. And then there are specific exemption entries, which I will not take you through here, depending on the individual situation. The respective relationship managers, you can touch base and they will share with you the specific answers on the specific transactions that you might be having with the government bodies. The next exemption is something which we already discussed: pure services provided to the government in relation to Article 243W are exempted from payment of GST. That takes me to the transportation and logistics sector and the recent GST Council meeting. There have been major changes in this front. As you are aware, that transport of specified commodities, maybe it's a rail transport or a road transport, were exempted from payment of GST. Now that list of specified commodities is thought to be reduced, and therefore one will have to be very careful about claiming the exemption for transport of those types of activities. The revised list we have already circulated in one of our earlier advisories. Please be very, very careful about granting. If you are in the logistics sector, please be very careful and satisfy yourself that yes, you are eligible to get this exemption, because otherwise at a later point of time, you might not be satisfying this condition, and then there will be a tax implication along with interest and penalties coming up. We are aware international air freight, both import and export, is exempted from payment of GST. Export sea freight is exempted. Import sea freight is not. Import sea freight, there is a GST applicable, but export sea freight and import export air freight are all exempted from payment of GST. As of today, we are told it's up to 30th September 2022. And every year we are told that way, and we invariably see an extension of the last date on the last date. We might see it again, but we really don't know. As of today, this is a timed exemption. It applies only up to 30th September 2022. There is an entry which says that road transport other than by GTA is exempted, and that entry continues the way it is. And therefore, consignment note becomes a very important aspect when we are looking at this entire matrix. For GTAs, as we are aware now, there are three options available. First is 5% forward charge without input tax credit. Second is 5% reverse charge without input tax credit again. And third is 12% forward charge with input tax credit. And a GTA is required to choose that option at the beginning of each financial year. And there is a specific elaborate code, and there's an annex form which has to be filled up and an annexure which has to be submitted, based on which the forward charge will be implemented by the GTA. Again, storage and warehousing services of specified commodities is exempted. This list also has been pruned, so we have to be careful about the specific items which are eligible for these types of exemptions. Now that comes the next part, which is healthcare, which we've discussed. Other than cosmetic surgery, and in other than cases where the room charges are above 5,000 will be exempted. Those two items are taxed. We've discussed about the electricity, the residential dwelling, and the going concern also. I think one important exemption is services provided by an intermediary, where location of both the supplier and recipient of goods is outside the taxable territory. Now, this is an example that, let's say, if there are goods, I am a person located in India. I'm making a person in US sell goods to another person in US, and I receive some commission. Now, because of the place of supplier rules, the location of the intermediary was creating a tax applicability. And that's where this exemption entry says that subject to certain conditions, where the supplier of goods is in US and the buyer of the goods also is in US, and there's a direct transaction between the two, and I get a commission, that commission will be exempted. As compared to this, we also are aware that even if you had bought the goods and sold the goods could have directly been shipped from USA to USA. This would have been excluded under Schedule 3, and therefore, even in that case, there wouldn't have been any tax implications. The next one is, of course, an exemption for legal services provided to any person or a business entity with a turnover less than 20 lakhs. Again, like the government entry, here also we do not want small taxpayers to be governed by the RCM proposition. And therefore, again, we have an entry which gives an exemption to those types of transactions. I think these are some of the important entries which were relevant for a general audience. And now if there are a couple of questions, we can take them up. If anyone has a question, they can unmute themselves and put it, or they can put it on the chat box. Okay, so I don't think we have questions. I hope you all are enjoying the series. You might be aware that all these sessions are also recorded and live streamed on YouTube. They are also available later on the YouTube for any.
Hello.
Yeah, Praveen.
I have a question. It's regarding the reimbursement of transport expenses. Like one of our employee transfer his household item from Pune to Navi Mumbai.
Okay.
So whether the RCM is applicable on that or not, I want to know about this.
Okay, so basically what you are saying is you are paying to a packer and a mover who is moving goods.
No, I'm not paying to packer and movers. I'm paying to my employee.
Okay.
Due to the change in the location.
Sure.
The employee moves his all the household item from
Yes.
Pune to Navi Mumbai.
Okay, so when you are making a payment to an employee, that payment is made under an employment contract.
Yes.
And therefore, under Schedule 3, there is a clear exclusion for payments made under an employment contract. Now, that's another matter that you might be giving him money for a specific purpose. That does not matter. No RCM will be applicable on this type of a payment where you are making a payment to an employee who in turn spends the money in a particular way.
Oh, okay.
Just to drive home another example, which is a very commonplace query nowadays, is a scenario where a company pays an employee as a house rent allowance or as a reimbursement of rent which has been procured on a house which has been procured on lease by the employee himself from the third party. So in these cases, we check whether the tenant as per the agreement is the employee or the company. If the employee is the tenant, then it is pure reimbursement. It's an employee related transaction. No RCM will apply. If the tenant is the company itself, then RCM will apply.
Okay.
So we have a question from Ritesh. He's saying, being a CHA, in transport expense, we are paying 5% RCM and avail ITC against the same. I presume you are, in your income side, you are treating it as a composite supply, as a bundled supply, and you are collecting full 18% tax from your customer, which is an exporter or importer. If you are doing that, your output supply is taxable, and the RCM of 5%, you are eligible to claim the input tax credit. I do not see any challenge in that front. Okay, so I think we have covered the questions and yes, please continue to enjoy these sessions and share your suggestions and feedback. Thank you very much.